So with all the preoccupation of investors with stocks and with interest rates so low, are bonds being unwisely ignored? For what might be seen as a biased point of view, we have the CEO of FIG Securities, Mark Payton, who I'm sure will set us right. Mark, thanks for joining us on the program.
My pleasure, Peter.
Now, you listen to all this stock stuff and you have to say, it's about time we started talking about bonds. Tell us about FIG.
FIG's a corporate bond broker focused on the fixed income markets, which is largely about a defensive asset class, investing in term deposits and corporate bonds.
History?
Been going for about 15 years, mostly focused on broking corporate bonds for the first 10 years of its life. We now have around 6,500 clients. Our investors have just over $9 billion in term deposits that we broker through various banks, building societies and credit unions. We're also a licensed custodian, and so our investors have accumulated about $2 billion in corporate bonds in their portfolios.
Tell us what you do to make it easier for smaller investors to access corporate bonds. I think that's an interesting part of your story.
I think the most interesting headline is that Australia has a bond market. It's over $1 trillion in issuance. The corporate bond element of that is over $300 billion. It's deep and it's liquid. 99% of the bonds on issue in the Australian market are held by institutional investors.
So they think it's a good idea, but obviously we smaller investors don't.
It's in your superannuation fund, it's in your pension scheme, but the direct ownership of corporate bonds in Australia is relatively low, less than 1%. So FIG is trying to change that. So FIG has established, the second headline is corporate bonds are typically traded in $500,000 parcel sizes. About 5 years ago, FIG launched an innovative service where we've reduced the minimum investable parcel to $50,000, and in the middle of last year reduced that further again to $10,000. So now an investor can buy a portfolio or invest in a portfolio of corporate bonds, $10,000 each, and so to create a portfolio of 5 bonds, $50,000, they can get some diversity in.
Do they get to pick the 5 bonds?
Absolutely.
Okay, so you go through and see if say, for example, Seven had one and a Telstra and all that sort of stuff, and you could put them all together, and effectively, do they know what the projected yield is?
The whole point about fixed income is you know that at the end of the life of the bond you will get 100 cents in a dollar back for the issue price of the bond, and you'll know exactly what the coupon or the interest rate that you'll get paid over the life of the bond, and you know exactly the date that it gets paid on. Whether the company performs strongly or averagely or weakly, providing the company can meet its obligations when they fell due, you will get certainty about the income.
And of course, Mark, the safer the company, the lower the yield.
Correct.
Yeah.
But also the longer term that they issue for. So the safer the company, the opportunity for investors if they issue a long-term bond, beyond 6 or 7 years, then you get priced for risk. So some of the infrastructure issuers in Australia, like Sydney Airports, for example, they issue 2 bonds, a bond that matures in 2030 and a bond that matures in 2020. And so you'll get a much better yield for the longer-term bond because you're committing to invest your funds out longer.
But during the early stages of the GFC, I remember seeing some well-known companies' bonds which you could have actually bought with a yield of about 27%. And that was because, I guess, the fear factor was in, the bond price had fallen. So you could have gone in and got yields of that magnitude, couldn't you?
Correct. A lot of assets fell during the GFC, and many of the funds had to dispose of assets because they fell outside their mandate. So whether they were shares or property or bonds or whatever, so that they were flooded onto the market and were discounted. So many of our investors made very wise purchases and were able to buy bonds at 80 cents in the dollar.
So are people able to buy discounted bonds from you?
They're not particularly discounted now. So asset.
No, but if they were.
Yes, absolutely. If markets adjusted downwards, and if there was an issue or a correction or whatever, and bonds were sold by the institutional investors at discounted prices, investors could pick them up.
I think a lot of people get worried that they don't understand the 2 aspects of bonds. The first and easy bit is I put 100,000 in a Telstra bond, and I'm going to get 6.5%. Well, as long as I go the distance, I'll get that 6.5% every year until the bond matures.
Correct.
But in the same point, if some mess comes along and bond prices go down, well, I can buy more and probably get even a 10% yield or something like that.
And if you need to sell your bonds are very liquid. They're traded very heavily, very deeply across the market.
Yep.
FIG itself turns over about $1 billion a month in bond trading.
Yep.
So our investors have ready liquidity for their bonds. But generally speaking, bonds in Australia are issued for a 5 to 7 year term.
Yep.
So if bond market's correct and you're properly allocated across your portfolio from cash and term deposits and bonds and assets, property and equity and all of the other things that you have in a diversified portfolio, the point of diversity is so that you don't have to sell assets that are a discounted values. But bond market is very liquid. The other point, I guess, of 5 to 7 years is you don't have to wait forever to get your 100 cents in a dollar back on the issued price.
Yeah, and you can sell out early if you want to.
Many bonds only have 2 or 3 years to go on their life, so you can invest with only a 2 or 3 year horizon. But investors in our kind of core clientele, who are retirees and people that are thinking about
they're playing a long game.
They want to invest to maturity. They want an income. They want to be able to. They've built their wealth. They're the beneficiaries of compulsory superannuation. They want to invest their wealth with certainty. They're not going to lose money on the capital, but they want to get a certain income.
And the only punt they're taking is that a company like Telstra remains viable.
The big issue is the big banks, insurance companies, big industrials, and a lot of infrastructure assets and those sorts of things.
Mark, how come financial advisors aren't big on bonds?
The financial advisory community, I think has to start with looking at a client and allocate broadly across all of the asset classes. So fixed income in Australia, as I say, because bonds are generally held by institutional investors, they haven't been, up until over the last 4 or 5 years, readily available to private investors. So a big part of our focus on research and education is focused on financial planners as well, and helping them to understand, the opportunity to advise their clients to invest directly in that asset class. In the US, UK, Europe, fixed income allocation, which is largely bonds, is 30 to 40% as a minimum in any portfolio. In Australia, it's much more like 10 to 15%.
So I guess in the perfect world, you'd love a lot of, because SMSFs would have actually taken away a bit of your business, because the old fund managers, they would have got into you, but SMSF people aren't all that educated or trained in the bonds. But you'd love them to ring you up and say, well, I've got 50,000, I'd like to get 6%. Can you give me a recommended corporate bond? No, you'd do that. That's the sort of thing you'd love, wouldn't you?
We'd start with an allocation message. We'd then have a portfolio of diversity. 82% of our clients are self-managed super funded trustees.
Okay, so they are getting into it.
They're people who have, they've been the beneficiaries of superannuation, but they're wise investors. They've built their wealth, and they're now taking it out of a managed fund. They're putting it into their own self-managed fund, and they want to directly own assets. So when they come to their fixed income allocation, term deposits and corporate bonds, I'd say we have an allocation, a bit of an over-allocation to term deposits in the Australian financial community. I think the allocation...
They're easy to understand.
Allocation to equities is about right in the Australian financial community. I think because of the GFC and the market context after that, I think a lot of money has come out of equities and gone to cash. And I think generally speaking, investment now is still set in that very cautious and over-allocated to an overly defensive asset class. And I think the opportunity for investors is to, instead of rushing all the way back to equities, to distribute some into corporate bonds rather than all going into equities.
Mark, great to talk to you. Thanks for joining us on the program.
Thanks very much for your time.